lend the government money, if you lend the British government money, they give you back a paper called the gilt. If you lend the US government money, they give you treasury. If you lend a company money, it's corporate bonds, they call it. If you lend a company money that, like GameStop at some point, you know, those companies that maybe they were already dying, it's still corporate bonds, but we call it junk bonds because they are high yield. They'll pay you high interest. Why are they paying high interest? They are not as attractive. They don't feel as safe. If you feel that you can get your money easily, then you are quite happy to lend money to somebody. Okay, I've got a slide on bonds, so we can touch that. So Suraj, yes, please. What was your question or your contribution?
Yeah, I think it's already been touched on. I mean, what are the things that I'll consider before I borrow money? Is obviously the capacity that they can pay back.
Absolutely important.
And obviously that I get something out of leaving my money to somebody's use. So what return can I get? Of course.
You are a wise investor, Suraj. Yes. And that's what Namdi was saying. How much can you give me back? And how much you can give me back, how much I'm willing to borrow you the money is based on how much I think I can get my money back. If I want to lend money to the US government, I think the US government is considered as number one in terms of the bond credit rating. They think US Treasuries is almost like you're almost sure you're going to get your money. So they might decide to pay less. I think US last night, I can't remember, but I think last night I checked, it was about 3-point-something%. If you buy their 10-year treasury, so you give them money, they'll give you back in 10 years, but every year they'll give you something. It will be 3%, 3-point-something%. I can't remember quite the figure. That's what it is currently, and it does change. So when you hear about interest rates changing, it seems like it's not your business, but it affects the stock market, it affects the price of your house, it affects your mortgage, it affects everything. So interest rate is changing. It means this is the interest they are going to be paying on that bond. So US government, if you lend them money, they're going to pay you that interest. Now, Venezuelan government might be willing to pay more, but should we give them our money? The government of the People's Republic of Venezuela, I don't know whether they're called People's Republic. Maybe one day I'll end up in Venezuela and I'll have to explain all this time I've been calling their name in podcast. But Venezuelan government, 10-year government bond yield is 10.43. That's Venezuelan government. Now, US Treasury bond interest rate is 3.66%. So US Treasury is 3.66, Venezuela is 10. And Venezuela is low at the moment. But why would people say, no, I don't want 10%, which is fantastic, by the way. I want 3%. It's because they think that US government can pay them back. There's a higher chance of US government paying them back. So the same thing, we'll come to that when we do risk premium. I think we've still got like about an hour and a half to go. When we get to risk premium, you see why it's important to understand these things. So you can see UK 10-year gilt currently is it 4.05%? Depending on which one you're buying, 4.05%. But when you look at other countries, let's say Mexico is well known. Mexico and Argentina, they've defaulted on bonds a few times. So can somebody type in Mexico government bond? I'm looking at it, but I just wanted to see it as well. Mexico government bonds, how much is their interest? Always use the 10-year own, and I'll tell you why. When you use the 10-year own, then you can compare your bond yield to your stock valuation, so you can know when you're getting a good deal. Has somebody managed to find Mexico bond interest rate?
I saw 9.5.
9.5 is in that range. Can you see that it's at the same level with the brother Venezuela? And let's take Argentina bond rate. You're not going to buy Argentina bond rate, but if you get a deeper understanding of this thing, so you know what risk you're taking each time, because there are times that the market will turn and we'll pack in bonds. We'll just wait in bonds, and when the market is better, we'll come back and buy shares. Again, if you're buying index fund, don't have to worry about all that. Okay, so Argentina, what do you say? 10-year bond. Argentina is 8.28%. I'll tell you one. I know you might have checked it, or maybe you don't want to check it, but let's do it. Let's just do it. What's Nigeria 10-year government bond? What's the yield is offering? Just type in Nigeria 10-year bond yield.
I saw 19.4.
19.4, yeah.
Isn't that something? So a lot of times, I know that Nigerian government has just recently released a dollar-denominated bond that went for 9% or thereabout. If they denominate it in naira, that's the local currency in Nigeria. For those of you who don't know Nigeria's local currency, they might decide to give you 20%, 19%, but denominated in naira, a currency that is actually going down. So that's another thing to also think about. In what currency is this bond denominated? Is it in dollars? If it's in dollars, okay, yeah, then you start looking at it. So you can see that countries that seem like they might not be able to pay back, they tend to have more, they tend to have to pay more. So the moral of this is not yet bond calculation. It's for you to understand that whenever you take more risk, you should demand more return. If you're just buying index fund, okay, it's fine, you might get 10, 9%. But if you're investing in individual stocks and you're not making far more than that, then why are you taking the risk in the first place? If you're buying bonds from US government, okay, fine, you're happy with 3%. Even at some point it was 0 or 0.1. In 2020, it was 0.1. If you're buying from another risky, let's say you're buying from a company somewhere in Austria, then you should be demanding more return. So anytime you're going to borrow money to somebody, they are starting a company, they are buying house, they are building house, whatever, you should always check what is the extra risk you're taking. Risk premium is another different calculation altogether, but you should always sort of like do a napkin calculation. Why am I giving this guy or this lady my money? If I put it in the stock market, I'm going to get 9% or 8% or whatever it is index fund has returned over the last 10 years. But if I give it to this person, he said he's going to give me 10%. So get out of here. I've had people approach me to ask for money, but like to invest in their business, and then they're offering me something I can get without even taking the risk with them because they're a bit more risky. Apart from the fact that I believe they should be honest, but they might not be. They're not government regulated. Nobody's seeing what they're doing. The other thing could also be if it turns out that they make a mistake or they have no experience in that area, so they are more risky. That's why sometimes you want more premium if you're going to invest money in a startup. That's why startups also people tend to get a bit more money from them. Does that make sense?
Yeah.
Okay. Right. Now, a little interactive activity. There obviously we've been talking about different investment vehicles all day long. And I'll tell you, because of how in-depth we went with each of them, we've covered quite a lot of the rest of the slides, so we'll be able to fly through. There's obviously, we've talked about fixed income assets, there's gilts, that's UK Treasury, UK Treasury bonds, there's bonds, there's Treasury bills. There's other things like mutual funds, index funds, and ETFs, which has a different slide for it. And there's real estate and other alternatives like gold. Some people buy whiskey, and some people buy oil. So you see all those adverts to buy whiskey, and you jump and give them your money to buy whiskey. Are you a whiskey seller? Do you know about whiskey? I always ask people, what do you know about whiskey? Have your grandparents produced whiskey? If you don't know anything about whiskey, why are you going to buy whiskey? And if the whiskey is going to give you 12%, but the government bond is going to give you 4%, you have to still think carefully. Say, am I being adequately compensated for the extra risk I'm taking? So those are alternative investment that people do. I'm going to give you a little exercise. I'm giving every single one of you here on this call £100,000. I thought I should be getting some more gratitude. Every single one of you, £100,000 for you, every one of you. Now, how would you allocate the £100,000 portfolio? You have 5 minutes. So, seeing the investment portfolios we've looked at. So, tell me, you can just use paper, napkin, it's not complicated, but tell me, based on the investment class we've talked about, tell me what percentage would you allocate to what and how much? And we'll come back again in 5 minutes. So,
this is my percentage. For 1 million, my percentage will be slightly different.
Okay, I'm going to keep it at 100,000 because I feel like as doctors, healthcare professionals, I'm not saying there are not doctors that earn 1 million per month, but I believe that 100,000 is relatable. But so thank you, that was a good job. So yeah, Suraj, I'm interested to hear what you've done with your own.
Well, I definitely haven't done anything genius, to be honest.
Tell me.
But what I can say is that, again, my allocation will be different 10 years ago if you gave me the 100,000 to where I am today now.
Okay.
Like in allocating assets, generally speaking, I kind of like to think about. I mean, no, the cliche around your 100 minus your age, and then what is left,
Yes.
you divide that into bonds and
Yes.
the stock accordingly. So
Okay.
taking that lead, I have just held just small cash. So 10% is what I've held in cash.
10,000. Okay.
All right,
Okay.
10,000 is what I held in cash.
Mhm.
I've put in common stocks at 20%.
That's individual stocks. Okay. Okay.
Individual stocks at
Yeah.
20%.
Because I was going back to ask Chi about that, but don't worry. Carry on.
I've put preferred stocks if I have the opportunity at 10%.
Okay. You're a sophisticated guy. You're a sophisticated investor. Okay. Let's go.
And I've put in fixed asset investments at 20%.
Right. So that's bonds, guilt, everything.
Bonds, skills, and that.
Okay.
And then I've put in 20% into real estate.
20% real estate. Okay.
And
Okay.
I've put in the last 20% into mutual funds and ETF and the rest of that.
Index funds, basically, mutual funds. Okay, so that's quite a nicely well diversified portfolio. For some people, their portfolio will be as simple as what she said, stocks. But in yours, you're sort of like you've touched different vehicles. Can I ask why? Why do you decide to put any money at all in
So basically, my approach is just trying to split things around capital appreciation and, of course,
income?
Income, obviously. As I near retirement, of course, I'll be looking at what is the investment vehicle that gives me more stable income.
Okay.
Even
And when is that? How far away is that? You don't have to say the exact years, but just roughly. Is it in 10 years, 20 years, 30 years?
Well, so if just going by the normal retirement age, so that would be in 20 something years.
Oh, okay. So obviously, when you're coming closer, you want to start going towards the
exactly. I
safety.
start going towards more fixed income assets that I can get more predictable returns, if that makes sense, and that can help to plan retirement a little bit better.
I love what you've done. I mean, I like Cheese Zone. Cheese Zone is simple, but in your zone as well, it seems like you're thinking in a bit more. You're thinking a bit more different options. You're thinking about diversifying a bit further. I think that's good. The allocation is not bad at all. You're putting 20% into fixed income. Is that correct? 20%.
Yeah,
Did you write
correct.
it down?
Yeah, that's
20%.
correct. Yeah.
But that's because you're 20-something years from retirement. But if you were 15 years from retirement, you might consider moving a little bit more, reducing your risk. We're going to go and look at risk now. Reducing your risk by moving more into bonds and treasury bills and things that you can predict that your money will not just disappear. Well, it doesn't disappear, but the value stays about the same. The price stays about the same. Okay.